So, as you heard, Zoe, the founder and CEO of Menai Financial Group. Zoe was at Morgan Stanley for 26 years, I think. That's over a quarter of a century. But your interest in all things digital really began when you were invited to be a board member at Ripple. So I think that's a good point to remember here. And you formed what is originally a family office, but now at its center is an asset management business focused on digital assets. Let's just expand on that one a little bit. Zoe's also sat on the main boards of Man Group and Old Mutual. AIMA is steeped in our subject matter in digital assets. I think you've been an investor in multiple sort of tokenized security investments. You formed your own firm, Ownera, in 2019, I think I'm right. And really what it seems to be is you've created an institutional grade digital securities network, trying to solve all the interoperability problems in our industry. Gosh, that's a word that's difficult. So I think we've got two very good panelists here to discuss what our subject matter is, which is that of real-world tokenization of assets. A lot's being talked about this subject. Larry Fink, as I'm sure the CEO of BlackRock, you've heard talk about this just recently, where he described this as the next generation for markets. I was looking at a publication by a research note from Boston Consulting Group, which was published last year, which suggests that the tokenization of global assets could become a $16 trillion industry by 2030. So that's more than you've just heard by our introducer just there. To give you a sense, the number that they put currently, or certainly back in 2021, it was only 2.3 billion. So from 2.3 billion to 16 trillion is quite some expansive growth. So I think really to get us started, and I think just to frame this correctly, we should just agree or certainly have a discussion of what we think tokenization is, because it can mean certain things to certain people, or it can encompass certain assets to certain people and not to others. So I'm going to start with you, Zoe, if I may, and ask you, really, what do we mean by tokenization? Can you explain to the audience what we mean by it? And then specifically what its applications are in the investment world. Perhaps sort of start like that. And, I mean, you can chip in at the end if you've got a different view on that as well.
Well, I am sure, sorry. So I'll go broad first, and I'm sure here my co-panelist will go to the definition that Larry Fink had in mind, obviously, when you talked about multi-trillion-dollar transformation. So for me, is it not working? Can you hear me? Yes? My voice is loud enough anyway. So for me, tokenization is the process by which you actually transform value, money, and real assets, where you and I can exchange value without a bank account, no matter where you sit in the world. That's tokenization. It encompasses everything. The beauty of a revolution, I do think this is as big a revolution in my career, and you used to be at Morgan Stanley as well, no?
You were long time. Yes.
Yeah. So anyway, what I say is this is bigger than the revolution that made my career, which is finance globalizing. When I joined Morgan Stanley, it was a small investment banking boutique, private company, 1,800 people, 3 offices. When I left in 2007, it was 60,000 people, had offices everywhere. That was a revolution. This is as big, if not bigger. I call it a Cambrian explosion. So before we get to the Larry Fink definition, for me, giving access to people around the globe that don't have access to financial markets, of the almost 8 billion human beings, more than 4 billion are either underbanked or unbanked. So if you look at the global applications, it's much bigger than the huge application that Larry Fink is implying. What Larry Fink is implying is really the Western world revolutionizing the way things are being done. Huge. But the much bigger revolution is the one that encompasses the world. So for me, when you actually eliminate intermediaries, if not eliminate them completely, you reduce the number of intermediaries, you actually have, and you give access, you increase liquidity at some point. This is the beginning. At some point, you increase liquidity. And in the Larry Fink definition, I can now have an asset through this tokenization process that I can use as a transaction, but as a collateral as well. So if I can use something as collateral, I increase its value. It's huge. On a scale of 1 to 10, we're at 2. So it's way too early to call winners and losers, to be dogmatic about anything. Bitcoin is going to the moon and Ethereum isn't. Whether KKR is going to win or BlackRock is going to win, whatever their tokenization process is. Way too early. There's one final point I will make. No matter what the application is, no matter what your specialty is that you want to excel in, talking to regulators around the world and to policymakers around the world, there are 3 things they will never negotiate away: investor protection, market manipulation, and AML KYC. No matter what company you are, if you follow those 3 things, you'll be very successful.
Great, thanks, Zoe. And I think whatever way or whatever definition one wants to put on tokenization, I think at the heart of it is increased accessibility. You said about the huge proportion of the world that is unbanked. Within the investment world, there are a lot of products that are inaccessible to a huge swathe of investors, particularly private investors, retail investors, which they can't currently get. So in many ways, tokenization partially, this is a question for you, Ami, is tokenization helping to solve that because of the underlying fractionalization that it represents? Who kind of benefits from tokenization in the investing world?
Yeah. So I want to start really with where we work within the world of tokenization, because as Zoe described, it's a very wide world. So there's tokenization of digital assets, there's a virtual digital asset, there's money, there's real asset, real securities. So I operate in the real world assets tokenization. So I don't have expertise in the other fields, but the field of real asset tokenization is what Larry Fink was talking about. It's what the CEO of Citi is talking about, CEO of Goldman Sachs, CEO of JP Morgan. My background is actually when I had my VC fund. And I saw the blockchain, and I saw Ethereum, and I saw Bitcoin, and I said, hey, wouldn't it be great if I could put my VC fund on the blockchain? And we did that, and that was the world's first tokenized fund. And that was about 5 years ago. And it was hard to do. Nobody knew what we were talking about. Nobody knew how to buy and hold a tokenized fund. So the fund was small, but what we realized was the technology had huge potential. And I think what's happening right now is that the banks and the financial institutions, the buy side, the sell side, everybody are realizing that the same underlying technology that was used to launch things like Bitcoin and Ethereum can also be used as infrastructure to replace very old, aging infrastructure in other markets, and especially in the private markets where there's actually no infrastructure in many cases, or no integrated infrastructure, where a lot of things are done manually. So we're talking about tokenization not so much as a future model for revolution, and which I think will come. But we're talking about a real use case, real use cases which are more, I would say, immediate, where we're taking infrastructure and deploying it within banks to add a lot of value to the entire value chain. A lot of value to the asset managers, a lot of value to the banks and to the wealth managers and to advisors, all the way down to the investors themselves. To your point, we're not starting retail. We're starting with institutional investors. We're starting with private banks and with private assets and private markets and so on. And the reason is exactly, investor protection and all of these things. They're just not there yet. We're at the very, very early stages of that. But these markets are so big. There are trillions, hundreds of trillions of dollars market. There are pockets of use cases where tokenization brings immediate and instant value. So we're working with JP Morgan, which is one of our investors, we're working on tokenizing repo market intraday repo market. So that's a use case that can do billions of dollars a day. So that's a very clear use case where you can work on it. Other people are working on tokenizing MMF, money market funds, private equity funds, and we do a lot of work on real estate tokenization as well, where I can talk in a few minutes about the values and who gets what and why. But this is basically where we operate within this market.
That makes a lot of sense, and I think what we're talking about here is that the technology is here for making vast improvements in the whole sort of process of investing. But Zoe, as you pointed out, we're right at the early stages of what is a massive evolution that is going on. In terms of the kind of the technology at the moment, is it and just a quick sort of answer from you, Ami, if I may. Is it already at institutional enough grade that it has the security, it's creating the efficiency that people are talking about? All these sort of benefits, are they as valid as people are talking about, or does the technology still need to advance quite considerably from here?
So what I can say is in terms of timing is I've been working on this for 5 years. So 5 years ago, nobody knew what it was. If you look at the banks today and the big asset managers and so on, each one of them has a team of anywhere between 20 and 400 people working on deploying tokenization-based solutions and infrastructure. It's a long build. So 23 is the year where we're building this, where we are going to have some water in the pipes, basically. Some initial deals, some transactions that you're seeing here and there, but institutional grade. What we've seen before was non-institutional grade assets going to retail and things like that. What we're going to start to see, just like KKR, but others as well. I had a conference in December, which I called The Asset Managers Are Coming. We had Hamilton Lane on stage in Aberdeen, and the likes of BlackRock are in the market, the likes of Vanguard and so on. So JP Morgan, as I said, Goldman Sachs, Citibank, they're all working on it. So 23 is the year where we're building the infrastructure. 24 is the year where it can start to scale. But like any digital revolution, once it starts scaling, it's quite exponential because it's very easily replicatable.
So beyond the technology, I mean, all markets need buyers and sellers. They need supply and demand. They need creators of product. They need distribution of that product. So where, from what you can see at the moment, where are we? What's the sort of status in that sort of dynamic at the moment? Because really that determines, as well as the sort of the technology and the sort of quality of the infrastructure, to create a real market and get to this number that people are talking about, you need sort of mass adoption. What are we seeing at the moment in terms of sort of supply and demand? For that narrower definition, if I may sort of keep you to that one, the Larry Fink one, if we can call it that, what is he seeing out there about supply and demand that makes him make such a bold statement?
Well, it's early. And so what he sees is 5 years from now, I mean, in my world, I'm old enough to remember that big things happened every decade, but the world is changing very quickly. So the implication is there's a massive hill to climb before you have massive adoption. So when he says this is going to be a multi-trillion-dollar industry, he's talking about minimum 5 years from now. The path from here to there is not going to be a straight road. So one, I would say how quickly it gets adopted is how quickly and robustly the technology can handle the volume. Because in the non-narrow sense, when you look at the macro view of the world, the cryptocurrency world, there is a lot more demand for it than there is the underlying robustness of the infrastructure. So I think that will have the same curve, that the demand is there and there will be a point, I don't know whether it's 2 years or 3 years from now, where you will not think of a world that's in the old rails. It will be in the new rails. So that's what he's seeing.
Yeah, that's interesting. And when I think about it, you say demand is maybe not really right there at this precise moment. But what really is there at this precise moment is the need, in my view. So if I think about sort of outside the institutional investing world, there's $150 trillion worth of wealth assets around the world who have minimal exposure to investments in what we think of as alternatives. So private equity, private credit, real estate, hedge funds, etc. $150 trillion worth, which probably has a weighting of well below 5%. Partly because they're not well informed, but also because they haven't had the accessibility that large institutional investors have had to those type of investments. You've got a great thing on your website, Ami, which I think sort of puts it in perspective, that there's almost 5 times the number of companies in private hands as is available on the public stock markets. 5 times. When it comes to debt, there's about 2.5 times the amount of private debt than there is public debt. And when it's real estate, it's just huge multiples, 30+ multiples of real estate held in private hands as opposed to available publicly. That can all become available, am I right, into that retail channel, if we can coin that phrase, use that phrase. So when I'm thinking about sort of tokenization, and you did the first ever, you said your VC fund was a fully tokenized fund, which kind of assets are most ripe, I think? You know, the need is there. In the early stages, which are the ones that are most ripe for adoption?
So I would say the one that we're seeing right now, kind of leaping forward, is real estate, especially institutional real estate. We're seeing also a lot of activity in private equity, and we're seeing, as I said, money market funds and treasury being tokenized. So these are the 3 that I'm seeing. We had another category, which is private pre-IPO companies. That was very big at the end of last year, and then the market crashed, and now nobody cares. But it will come back, and when it comes back, this is another category because private companies are staying private much longer. They don't go to the market, and still their early investors want to have trading, and liquidity and so on. But the key things we're seeing now are those. And I would take, to make it really concrete, I will take one example. So if we look at institutional real estate, about a $10 trillion business. Mm-hmm. The way that it works today, somebody wants to do a project, $200 million project. They would go to a bank. The bank will maybe syndicate with 2 other banks. They will go to a few pension funds, and that's it. That's the market. Ticket sizes are big. You invest for 20 years. Once you invest, you forget about it. You just keep getting the. As he told me, as the CEO told me, I can only sell to people who manage other people's money because there's very little liquidity and you just get the interest. And that was their market for a very long time. Once you start tokenizing, they can do a few things. First of all, they can have smaller tickets. They can have more fractional kind of ownership, and they can start distributing it to wealth management. So they can go to family offices, high net worth individuals, and so on. Give them access to these products that until now were only available to pension funds. Then they can provide liquidity through over-the-counter ability to have to IOIs, like I want to sell a portion of it, I want to buy a portion of it. So it's not high-frequency trading, but it is some trading. Currently, liquidity is 1% a year in this market. It could go to 5%, it could go to 10%. But that's nothing. The most important thing is what Zoe mentioned before, is collaterability. Because suddenly, the bank can very easily come in and offer you a loan against this asset because it's tokenized. If you default, they can take the token rather than having to go to court and try to locate and find where the. So it's a lot easier to offer collateral against it, and therefore this asset that you used to have as a sitting for you for 20 years can start to be used and used for leverage and so on. So suddenly it's becoming very attractive to them because they can go to new audiences, they can offer the same exact product, it's the same exact real estate, but now it has a liquidity premium and the fact that it can be collateralized. So for them, it's really, really exciting. But if you flip it on the other side, the investor, the family office, they didn't have access to this before. They could buy a Vanguard, wide exposure, but they can't buy a building in London. If they wanted a building in London or a bunch of buildings in London, they have to go to London and buy a building, right? And so if your Aladdin tells you this is the exposure you need, what do you do? So in that market, and we're seeing this in scale. So the real estate manager we're working with, they manage $6 billion directly and another $30 billion indirectly, and they want to tokenize the whole thing. And you hear the same thing from a lot of asset managers, where they're saying, you know what, we're going to tokenize effectively everything in the end. And the reason is that Tokenization for them does two things. One, it gives them savings in efficiency and cost saving. And even, for example, paying dividends is a click of a button, everybody gets a dividend. So cost efficiency and saving is on one side, but on the other side, growth and liquidity and the ability to reach new audiences. So it's a very real use case that is quite immediate when you see it. But the market today is analog. Everything is being sold by phone. So that's a clear use case.
Yeah, please do so, yeah.
Something to what Ami said. Clearly, this is the beginning of something big, I agree. Siemens, which is a 175-year-old institution, issued a bond and sold it directly without an intermediary to 3 investors. Big deal. But it's a gnat. It's a 0.001 of the whole market. So to me, ironically, the thing that will give impetus and focus, and we've talked to a lot of multi-billion-dollar family offices, and I call them institutional-grade family offices. Right now, their number one concern is the macro issue of the world, where fiat currencies are being questioned. And there's a great book that's becoming a big seller again, When Money Dies, and it talks about the Weimar Republic, that world where the Deutschmark was okay, and then it was less okay, and then binary, it was not okay. So a lot of the impetus, a lot of the demand actually is the tokenization of real assets. In this particular case, people think of gold. You can digitize, tokenize gold. We talked to a very, very big energy company. They want to tokenize oil. And so the rails are being built, but the demand that is immediate, there is no one we talk to who is not interested in actually that hedge. And that's, to me, the topical discussion. I'm sure you all talk to your investors or whoever you are about. How do you create a portfolio where for decades, again, 60-40 portfolio, 40-60, last year was the first year you lost a lot of money, not a little bit, a lot in both stocks and bonds. So the demand is coming from this alternative investment vehicle that takes assets of all kinds, the alternative assets, and turns them into more liquid form, transmissible immediately.
No, it's a good point. So the demand is there, the need is there, the kind of the building blocks are all there, but we're still in the early stages. Yeah. There are a ton of hurdles to overcome. Perhaps we can just sort of touch on what some of those might be, and what do we need to see to kind of just accelerate this towards that, big lofty type. Is it technology? Is it education? Is it regulation? You talked about it. What do regulators care about? Do they feel comfortable enough at the moment that those 3 things are being met? Have we nailed down what voting rights are? Who is the beneficial owner? Is custody safe? Counterparty risk? Which bits still have the greatest need for a solution?
So there is one core technology problem that needs to be solved, and that's the problem that we are trying to solve now with the big banks, which is interoperability. And I'll explain what I mean. Tokenization of real assets is not like crypto. Crypto is easier to trade in a liquid way. Why? Because it behaves more like a bearer instrument. I'll give you a simple example. If I send Bitcoin to you, now you lost your key. It's not my problem. It's your Bitcoin. It's not my issue. But if I sell a building to you and you lost your key, you're not suddenly not the owner of the building. You're still the owner of the building. I just need to give you a new key, right? So actually, you still have the centralized management, the agency process. It sits on a blockchain now, but it still has to be done. Now, because it's much more complicated, a lot of the data is not on the blockchain. It's personal data. It's private information. Every tokenization solution built a silo, and they couldn't connect to each other. So unlike the world of blockchain in the public market, like Bitcoin, where everybody can trade with everybody easily, JP Morgan will issue a tokenization asset, maybe a client from Goldman can't buy it, okay? What we're doing is we created a group of about 80 financial institutions, all the big financial institutions in the world, and we launched this protocol that interconnects everybody to everybody. And now that is being sold, it's being deployed with multiple banks, and once that problem is solved, you can start addressing a supply and demand. Because what the problem was, you said correctly, all the assets want to tokenize, all the clients want to buy, but it didn't happen. The reason it didn't happen is that the asset didn't come until there was distribution. The distribution didn't come until there was assets. So where do you start? The answer is we started with the assets. And the reason we started with the assets is because they gain the value of efficiency and cost cutting. So they do it initially for the cost cutting, and then once they're there, distribution is arriving, and then suddenly you get the growth as well. So it's a two-sided market that you have to kickstart really, really hard in the beginning, and that's what we're doing this year, kickstarting it. All these new initial things are starting, and then it will grow from there because the demand and the supplies are definitely in place.
Just to add to what Ami said, for me, this new technology, this new revolution suffers from the trilemma problem, which is a term we borrowed from the macro world. And in the macro world, as a central bank, you cannot have a fixed exchange rate system, freely floating capital, and an independent central bank. You can maximize 2 out of 3. You can't have your cake and eat it too. So in this world, as Ami talked about interoperability and all that, the trilemma problem is that you can't have all 3 of security, decentralization, and scalability. You maximize any of the technology that we're all looking to maximize for. You choose, of course, security, because if you don't maximize that, you're in a world of trouble. So you're always going to these different technology applications, and that's why each token is designed fit for purpose that it's serving. If its purpose is scalability, it has to actually negotiate down decentralization. That's what Ripple has suffered from, why the SEC is suing them, because they're centralized, they solve for scalability. You can do thousands of trades in XRP in nanoseconds, but you're not decentralized. So the trilemma problem will exist, and I think there are great technologists. The thing that I'm very excited about, why I'm still staying in the space, even though there are way too many shysters in it for my own benefit, my own peace of mind, is you look at young people. At Morgan Stanley used to hire astrophysicists to do securitized products. They're not interested in going to Morgan Stanley. They're interested in actually really revolutionizing this technology that you're talking about. So we're going to solve problems, but it's not one size fits all.
Well, I'm going to bring it to a close in a bit, just for some kind of, to get some of your final thoughts, but just the one thing there we haven't talked about, and perhaps we haven't got the time to talk about, is ultimately liquidity. You know, we're saying that, you know, the distribution, the creation of the product, and demand, and is there, but ultimately faith in any market is maintained by your ability to be able to buy and sell securities when you want to do so. Liquidity, and I guess we're still a ways away from having the kind of scale out there to determine exactly how that will pan out. But to me, it's a very, very important thing that will need to be need to show its existence for the tokenized market to thrive. So, just thinking about the audience here and what we can leave them with, you know. The size of the opportunity is enormous. I think that we all agree that, and it's over the next 5-10 years or so. So, got fresh faces in here, all eager to get into something early or understand something early. What is success going to look like in the asset management industry, say in 5-10 years' time? And what would you recommend to people here in the audience if they want to be a winner in that? It's a difficult question, that one, and you might not want to tell them they're going to be a winner. You want to keep it to yourself, but just give some ideas of what success will look like and what you have to do to be a part of that success.
I would say understanding that it's a highly risky investment, that the possibility if you invest in this version of the asset management world, you're talking about however you define risk, volatility, operational risk, however you define risk, it's very risky. You could lose most of your money, or you can make 100x. In my career, I've seen a lot of investments where I lost most of my money, but not 100x unless I did the right VC investment. So for me, success is zero allocation to the space is the wrong answer. more than 2 to 3% in this new world of investment management is also the wrong answer, maybe 5% if you're really bullish. And then invest in a number of tokens, or however you define that tokenization, that are diversified, that are pointing to a use case. Because for me, any token that points to a real world use case, that creates users of 400 million people around the world, that token will be valuable. Way too early to call winners and losers. In social media, MySpace had 90% market share, Facebook 5% market share. We know how that movie ended. You needed to own both. So success looks like give it to adults in the room that know what they're doing, invest in a diversified pool of assets, tokens, on this blockchain technology, and focus on 98% of your portfolio that's in deep trouble, and it will be in deep trouble for years to come.
So I'm going to leave it with you with a very easy question, or a simple question to answer, hopefully. So if you're an asset manager today, and if in 7-10 years' time you have not entirely immersed yourself in the opportunity to be an asset manager around tokenized assets, do you still exist?
Look, I come from a different world. So I work on the infrastructure of taking this world, which is analog, into a digital. So I have in my pocket our app. And in my app, I can go in and I can see assets, real estate, private equity fund, which until now were only available through sending my lawyers and signing 9 PDFs and reading 90 pages. I can click a button and invest. I can click a button and borrow against it money. I can click a button and sell against it. Now, in my previous career, I built applications that were used by tens of millions of people. So I know how application actually works. Once investors have these type of applications in their hands, on their screens, right? If your asset is not there, it's not there. They're not going to buy it, right? Because it's the assets that are there are going to be the same exact assets you're buying off platform, without the liquidity, without the collaterability, without the online data and the reporting and all the ability to optimize your portfolio and all the other data things that are there. So the reality is, if you're an asset manager, 5 years from now, if you're not on the trading platform of alternative assets, nobody's going to be investing in your assets, or it's going to be very hard to reach the investors, because that's where the investors want to be, those platforms. It's a very much an infrastructure story.
Yeah, good answer. So keep up to survive, if not, beware. Listen, Zoe, Ami, thank you very, very much indeed. Please give a good hand to my panel.